Real estate searches in Canada hit a 5-year high this year, 2026. And inside that pile of queries and searches, two main themes dominated everything else: renewal anxiety and investor curiosity.
We pulled the CMHC Mortgage Consumer Survey, Google Trends data, and what brokers and lawyers across the country were getting asked over and over. And today we're going to be answering the 9 most Googled questions. No filter.
I like doing these episodes. It's fun to see what people are looking at out there. Okay, so we're going to do 7 main questions, 2 bonus rapid fire questions at the end. Obviously, some of these are, macro takes, as we like to do on this show. Some are tactical, as we also like to do. And some are kind of just stuff that you should know. And all of them are things that real people, maybe even you, are typing into Google, maybe Claude, maybe ChatGPT, and trying to find the answers, maybe at 11 o'clock at night when you should probably be going to sleep.
Experience.
Well, Dan, it's currently 9:30 and we're recording a a so
yeah, so
maybe we should go to sleep.
To be honest. Yeah. Well, let's get into it anyway. Start us off with number 1, which I'm surprised. Was this one because it's the most, or it's an indiscriminate?
It's a bit of an indiscriminate list, but I would not be surprised if this was number 1, especially this year with all the renewal cliff activity and stuff. Okay, so the first question: fixed or variable in 2026? Dan, this is relevant because, again, millions and millions of Canadians are and have been renewing their mortgages, right? So the most Googled question in Canada, so it is the most Googled question every year, funnily enough, but especially this year, it's the state of the rate. Okay, so what is happening in the mortgage market as of right now?
I thought it was date the rate.
That's a different concept. Right now, the best 5-year variable is around 3.5% to 4.5%. The best 5-year fix is around 3.7 to 3.8. Variable is currently a little bit cheaper, but variable changes, and a lot of people got caught in that. So that's why people are asking this.
Yeah. I mean, you go to that CMHC chart that we met, you can see that period of time when people were piling into variables, and now variable is the most popular single mortgage product. Although in 2021, it was like 56% of all mortgages. Wild. So it was like more than everything else combined, but now it's about 42%. But it tracks, actually, if you go over to the Google search trends, that fixed versus variable. The only time that search trends have been higher than it currently is was right during the rate hike cycle. Like when they fired the warning shot, it was like, people are like, what do I do? So anyway,
what does this mean?
Bank of Canada, Bank of Canada now, pretty firmly parked, it feels like, at 2.25. I think they're expected to hold there throughout the year. That seems to be most economists' consensus, which would mean that variable rates probably won't move much in 2026. And I think they're at a bit of a discount. People are just capturing the discount, maybe less than the downside, trying to get future rate cuts priced into their mortgage rate, I think.
Totally. And I mean, this is the age-old question, right? Fixed or variable, comfort or risk. And fixed right now is a bit of the wild card, right? The 5-year fixed, that's tied to the 5-year Government of Canada bond yields. And most forecasters expect fixed to drift higher by the end of this year, possibly to the mid 4s, higher 4s by the end of the year. Of course, this all depends on so many things, right, Dane? We track bond yields all the time in the commercial space. And guess what? Bombs get dropped somewhere else in the world, or U.S. trade stuff.
Doesn't seem to like bombs.
No. Bond yields don't like bombs. And I feel like most people and things would rather bombs not go off.
Except the governments, apparently.
Defense contractors and stuff maybe. But yes, mortgage bonds, which play a crucial role, and government mortgage bonds, this is the stuff that moves the market.
And if you want to go back, I think it was like 80 years of data when the last time we brought this up, or like 100 years of data. Your variable rate actually beats your fixed rate about 80% of the time over the last 30 years of section. So I think there's like 1 or 2 mortgage terms where you wouldn't have won. So that's not 20. They do. The problem is when they do it catastrophically, as we learned in 2022.
Like Anchorman, like it works 20% of the time every time.
Yeah, it's pretty much like literally exactly.
Yeah. I mean, look, so I guess to speak for both of us here, Dan, our take would be, like, if you're a stress-tested investor or a buyer, in this market with stable income and a bit of a tolerance for payment changes. Variable is the math winner.
Pricing mostly, right? Because what are they, like 60 bips low your fixed right now?
It depends on the lender, and of course depends on the borrower and the product. But yeah, you're already lower today, and if you're not expecting rates to rise, then maybe risk it and get into the variable.
Yeah. Yeah, I think the one thing I really like about the fixed as an investor is just that the predictability of principal pay down. It's just easy to model when you're going to be able to do the next deal. Like, exactly how much principal you'll have paid down by the time your mortgage is up. So, I mean, if you're tight on cash flow, obviously, maybe not for you. Pay the premium to have the certainty. I think the math being better doesn't matter if it's going to keep you up at night. I think that the last 5 years have shown us that there are periods of time where that is very, very possible. And so I would encourage people to be exceptionally careful with those credit types.
Yeah, here's some math for you. If you're not getting 7-8 hours of sleep, you can minus a lot of good things from your life. So get some sleep at night, and if your mortgage is causing you nightmares, then lock in.
Yeah, and somebody with I know that for sure.
I mean, that's a good excuse not to get sleep. You don't need your mortgage doing the same thing.
It's still talking about math here. It still doesn't make me get more.
There's also a middle ground here too, Dan, that kind of gets forgotten about a lot if you're in our world base. That's kind of the shorter fixed terms, right? The 2 or the 3 year splits the difference.
That's your
a
second
little
most
bit.
Popular, like
for sure.
3 year fixed is 32% of mortgages right now.
Yeah.
The other thing you can put multiple credit facilities on. Like you can have like half of your mortgage fixed and half variable now.
There's certain products that offer more complicated stuff like that. Like the average buyer, the average investor, isn't gonna take advantage of that kind of stuff. And I would advise most people to no. I mean, again,
just pick a lane, man.
Just pick a lane, right? And you're either going to pick a lane with a little bit of risk and monitor the situation as one does these days, or you're going to lock in and as you have that comfort of knowing exactly what comes out of your account every month. This lock the shorter fix, it locks you in the pricing because the yield curve is a bit flat, so it gives you the exit optionality before that next big rate hiking cycle or rate cutting cycle, and that hopefully you'll be a bit more in tune with and not get caught in the crosshairs.
The same economy that we are right now in 3 years, man.
We would be in big trouble if we are.
So the one issue, and I'd have to check the rates, but like the last time I was looking at rates on a refi that I had coming up, like the 3 year was a little bit more expensive than the 5.
Yep.
And so, yeah, the big piece of the puzzle here is just going to be pricing. Like, how is the variable so much better price that it's worth taking the risk on rate volatility? Is the 3 years so much worse that you'd rather get the 5? Like, it's going to vary on a deal by deal basis, and like what happens.
And a person by person basis too, right? Like this really is a very personal choice. Like when I'm advising clients, and I still do, help res business. And when I'm advising res clients on stuff, what I like to do is I like to lay out all the options, explain everything, and then let them make that decision because it really is a personal and very financial decision. So there you go. I mean, question number 1, we're not providing an answer. We're providing information. You go and make your choice. Dan, hit me with numero duo right here.
Yeah, this is a scary one. Question 2. I can't afford my mortgage renewal. What do you do? This is the
Yikes.
Searches at historic highs question.
Oh, that's
over 1 million Canadian households renewed this year. We know this, right? The average payment shock is about 20% up from the pandemic era rate they locked in, which isn't as bad as it was originally expected to be, but still.
Yeah, I mean, look, 20%, that's the average. There's obviously a lot of people that are above that, a lot of people that are probably in and around and below that. But for anyone in that situation, the first thing is don't put this off, right? Do not kick this can down the road. It will come back to bite you. You got to start months and months, ideally 6 months out. Don't wait for the renewal letter to come in the mail. November 2024 rule change means that you can switch lenders at renewal without re-stress testing, but only if you keep the same balances and amortization. So look, you can get out and shop around a little bit, right? Talk to your lender, talk to other lenders, engage a mortgage broker, get ahead of it. If you are expecting trouble, get behind the wheel and steer this ship into calmer waters at the very least.
Well, I think push your existing lender, like the A side is getting so competitive on renewals,
Really.
presumably because they're not doing much acquisition business. Like nobody's really buying stuff. We're at record low sales the last 2 years. So
Well,
not
what was that
record, but
stat
like,
that we saw when we were covering like the banking industry and their mortgage? It was like they did a huge hiring campaign for internal underwriters dealing with renewals and weren't hiring
Yeah.
any new kind of like mortgage BDMs or like
Yeah.
mortgage, not
Yeah.
brokers, because not brokers in the broker channel like within the banking system, but and like, look, the numbers don't lie.
Yeah. So the easiest way to do this would be, like step one would be get a mortgage broker to shop your renewal to at least 3 lenders. And even if you're doing this just to get, keep your existing lender honest, that's a good way to do it, is present them with real data points. Hey, I can go, I'm at this bank. I can go to I'm at the blue bank. I can go to the other blue bank, whatever, 50 basis points less. If you match, save me the headaches and I'll check the box, so go do, if you don't, it's maybe not an exceptional use of a broker's time if they know that you're just doing it to, to try your existing.
Mortgage brokers are cringing listening to this, but it's that kind of market,
So,
you got to work.
well,
You got to work.
Yeah, I mean, if they beat it, they should earn the business. But I mean, I think if you don't want to be disrespectful to mortgage brokers and ask them to do a bunch of work that you're just going to use to beat up your existing lender, maybe just go shop them yourselves, or just pull up Rate Hub or Wawa or whatever and be like, well, I can get these 4 mortgages. Can you guys get me that rate? No? Okay, well, I'm going to go and inquire about those.
Yeah, look, another one that, I don't love advising this kind of stuff, but these are this kind of desperate times, desperate measure type of actions right here. If you really can't afford your renewal, if the math really still isn't working, talk to your lender about extending that amortization, right? Go from 20 to 25 years, that can drop your monthly payment.
I got to find the data point, but there's an insane amount of people who extended AMs this year.
Oh, for sure. Yeah, look, it's an easy way to relieve some of the stress, right? Like you pay more interest over your life and your ownership.
Meaning it's like 30% more.
A ton more. But it's kind of like, do I want to blow up now or kind of bleed out a little bit more over the next couple of years? And maybe when times change, maybe you put a lump sum down or something like that, right? Like for some people, hopefully this is a temporary fix, but this is where we're in the cycle. It's tough.
Yeah, it's tough. Yeah, it is. It's really hard, man, because it just becomes a big cost benefit exercise. I think if you I want to say to people, if that's like a question you're asking yourself, maybe you should be considering just selling. But then selling comes with cost. Like, okay, well, now I gotta pay a realtor 5%,
lawyer,
loss, and then I go rebuy and I'm getting land transfer taxes and I'm renting for a period of we'll add in all those opportunity costs and what's my okay, like now I'm thinking if I'm gonna lose that or pay that extra however much interest over the next the extended amortization that I'm doing right now, maybe again the cost of it is better for making that move than selling and absorbing all those switch. I mean the other challenge is that I think if you go to an extent changing the mortgage product, so it's a refi not a renewal, sometimes they will offer you though just on the renewal.
And this is where again conversations with your lender and I urge those listening who are in this position, I urge you to go and have these conversations. Yes, engage a mortgage broker if you want to. If there's ways around that, in a lot of cases, people really don't want to have to change the product because a refinance means you get re-stress tested and incomes might not be what they used to be. That can kind of that can of worms, Pandora's box, whatever, right? But this goes back kind of the main theme here, which is if you still can't qualify, you got to talk to your existing lender, because at the end of the day, the banks don't want your house, okay? They want payments. So banks in a lot of cases will grant you temporary relief, interest-only periods, even in some cases like a skip a payment option. They get creative. And this isn't advertised as well. Yeah, of course they do, because it's responding to the market, and they don't want to put a bunch of their stuff
at record lows.
Yeah, but they don't want to put a bunch of their borrowers into default. I mean, why would we've talked about power of sale a whole bunch of times, and this is a result of this kind of behavior. So this is the bank stepping in and putting that stopgap up and saying, let's work together to figure out how to you stay in your house and you keep giving me money.
Yeah. I think step 4, if you've exhausted the options, is what I was saying before, is if you can't lever your way out of this problem, or, dead ahead, one might say, you got to sell. And a lot of investors have a hard time coming to terms with this one, man. I do. I have, honestly. It's like you feel like you failed. Oh, you didn't win. There's something about it. It just feels wrong.
Shame, investor shame. Yeah, like I was team never sell, and now I sold.
Yeah.
I
Go
can't
from
tell
deal
anybody.
to sell mogging or whatever. I don't know. I'm trying to learn my
Deal maxing and sell mogging. Wow, that's fantastic.
Yeah, so
I don't know if that's the right use of mogging, but
no, I have no idea what I'm talking about, man. But I'll try. I'm gonna learn. I'm gonna look. I think that ego is very, very dangerous in investing, and especially in levered investing, which real estate is, and pride can be one of the most expensive emotions in real estate. So I would be like, we're in a market where you really have to have your some of your assets and say, man, there's like assets like Johnny and I own together, and we're like, there's one, like, it's a big piece of land, and I'm always like, I just like this
yeah,
asset,
no,
but it's
I've been there. I've
really
moved
not
stoves
a good
around
idea.
there with you boys. Yeah.
You go to the back of the woods, and there's a cabin there, and crack some cold ones and whatever. It's like one of those properties where it's like hard. That's a hard one to part with.
Yeah.
And it's not even a pride thing, but it's just dumb. I'm just being dumb, So
well, listen, this is emotions, right? And like, you are an investor, you're a numbers guy, but still there's like, I think what it is, it's like, as investors, you have a plan, whether you want to admit it or not. You've got a plan and a dream for every property. And when that dream or plan isn't realized, or you're in a position where you're forced to sell before being able to, even if it's an unrealistic dream, it kind of hurts, right? It sucks. So look, I think the number one mistake here, and again, to reiterate the question, if I can't afford my renewal, what do I do? The number one thing that you do is you get ahead of it. Okay. We just gave you a whole bunch of ways to deal with this. Waiting until 30 or 60 or 90 days before the renewal to not think about it, to not have a plan, to not talk to your partners, your options get fewer and fewer. Deal with this up front. Get ahead of it. Months ahead of it is the best advice. So anything else, Dan, or should we move on to question 3?
Yeah, hit me with question 3. This is a good one. This is funny that people are Googling this. We need to do a ChatGPT version.
Okay, question 3. Will house prices go down in 2026? I mean, look, it's a question that nobody can really answer honestly. Will they go down? Yeah, they have been going down. Will they go up? Maybe in some market. Let's take all the BS out of it and answer it as honestly as possible. Hit me with the national snapshot here.
So the national snapshot is the average home price in Canada is about 673,000 as of March. It's up 1.4% month over month, which doesn't matter much in the spring market, I would say. Prices usually rise on the average basis, like from January till May or June. Year over year, functionally flat. I mean, we're down, I think, 4% from like May over May. You're down like 28% off. So, you have this idea where people are like, is this has the correction like bottomed out? It's not going down steeply, starting to flatten. And I think are really like trying to call the bottom, right? People are really trying, and they're asking, how do I time the market perfect? And so, but it's interesting to see. That's kind of the fact that people are asking tells me that they think that there's maybe a chance that they're not going to continue going down.
I mean, you ask a realtor, the realtor gives you an answer, and you're like, whatever. You don't know what you're talking about. I'm going to go check Google and Claude and ChatGPT. These questions so far, they are very telling of the market where we are in the cycle. But of course, with Canada, the national picture is much more of a regional split, right? Calgary, Edmonton, Atlantic Canada. As we said in a prior episode, Dan, still appreciating. Still going up in all these markets for the most part, right?
A lot of markets at all-time highs, man.
All-time highs, dude. Yeah. But then, the usual suspects, the Toronto, Hamilton, Vancouver, the essentially GTA and Lower Mainland are flat or have declined a ton or still kind of on their way down. Then you unpack the asset classes, right? Condos specifically completely screwed in a lot of cases. Weakest they've been in a long time, if not ever. The subcategories of that, like the assignment market, just walk away if someone tries to do that with you right now. Talk what we're seeing in prices.
Yeah. I feel like a lot of people are speculators, just like have a hard time admitting it and being like, having trading psychology and being willing to cut their losses and move it into a better investment. Like, let's just range of potential outcomes. If prices were to go up, it would be continued immigration, which we're not seeing right now. Housing supply still being well below demand, which I don't really think we're seeing right now. Mortgage rates not rising. I mean, maybe even falling would be kind of necessary if we're going to try and if I'm trying to say what make prices come up. And the renewal cycle pain being done, like being behind us, that's obviously been suppressing some demand and creating some supply. Does getting past that help prices move up? And I, you can run through that list. I think I accidentally injected my opinion on a couple of them, but what's the likelihood of most of those things being the case? And then the question, what are the factors that might push prices down?
I mean, look, there's a whole bunch of them right now. It feels like just about everything could affect prices negatively, right? Recession risk, which I haven't heard a lot about the recession that we're in right now, but we technically are. Again, trade, tariff pressure, businesses leaving Canada, all that stuff. The condo issue in major cities is still impacting the overall market. Renewal payment shock, which we've just talked about. It's causing forced sales, causing a lot of stress and uncertainty in the market. Cooling immigration. Take your pick, right? You want me to keep going? There's so many.
Yeah, you mentioned the U.S. tariff pressure. I think I'm in the Google search trends console right now to pull up charts for this. So I just searched Kuzma, and Kuzma is at an all-time high for Canadians searching. I mean, all of the things that you listed seem like more likely things to be happening than any of the things that I listed. I think most of the things that I listed probably won't happen. So my guess would be that prices, maybe policymakers are obviously making a meaning to step in here. So can they make that happen? Broadly flat to I think flat or like that continued grind down. And I think it's a difference, real and nominal prices as well. Like real house prices adjusted for inflation will likely be lower because inflation is still running hot and prices are not going to outgrow them. But I think what the bigger theme is, you'll see this like significant regional divergence where you're seeing some of these markets where people can afford to buy houses, or they'll probably continue doing fine as long as nothing catastrophic happens to their individual economies, and people can continue to afford to buy houses in those markets. The markets where unemployment's highest, Ontario, and a lot of places in Ontario, and prices are still like brutal. I don't see how they don't continue moving down towards a place where price to income is more appropriate and people can start stepping back into the market. Condos, obviously, especially in Toronto and the GTA and Vancouver, still under pressure, although it sounds like the government relieving some of that pressure, perhaps. Is that the most diplomatic way I could say that?
Yeah, just a little back massage for the largest developers and banks in the country. That's okay. That's for another episode. The bigger point here, I think that you need to just keep reiterating, and we have been for years, is stop trying to time the market. Okay, I hate to say this again, but it's time in the market for a lot of people, not timing the market. No one knows when the bottom is. No one knows when the peak is. If we did, there wouldn't be a bottom and a peak because we would all know. People who waited for the crash since 2014, they've missed generational appreciation within that last decade or more. People that bought at the 2022 peak with cheap money that thought they were geniuses getting in are mostly fine because in some cases they're not selling, or in some cases they are totally screwed because they bought at the highest with the lowest rate and they were on a variable. There's ways to make mistakes in a good market. There's ways to make mistakes in a bad market, and there's ways to get good deals done in both. But buy when you have the financial position and are ready to do so, not when everyone else is doing it or when everyone else is selling or any of that kind of stuff.
Yeah, and we just did an episode on first-time home buyers and what's happening there, and I think our contrarian take on this whole thing would be that the next leg up would not be coming from end user demand. Like first-time buyers are owning the market right now, and the market's not going in a good direction, so we cannot rely on them to prop the market. No, but I think that
damn 40-year-olds.
Yeah, they're spitting houses down. You think, when investors start moving back into the market, and we see you, by the way, because like our numbers are oddly doing well. And, Nick, you and I were having a conversation about this earlier today. It's like, I've had some weird calls with like smart people with, a lot of money that are like rotating out of stocks because they're like, stocks are just so scary. Like I'm hanging onto the side of the rocket ship and I'm loving it because I'm going to space, but I'm also like, this is scary. This thing could blow up at any time. And I think
Smart money's
like,
making moves in real estate right now for sure.
yeah, and so they're looking at the real estate. They're like, well, what asset class is the rocket ship that already blew up, and how, like, salvage some of those pieces that are laying on the ground. It's like that they kind of turn to the, and so I think the asset class is some interest again, like from the capital side, which is fascinating to me because I didn't think it would happen this early. And I would say, when I say interest, like early, it's like, the sales cycle for this is long.
Yeah, don't get too excited,
12
people.
months, whatever. But
this is not Dan saying
I'm not
calling the bottom and we're on the way up. Okay,
I gotta be careful what I say, man. Everybody's here we go. And then so I get a message next week. Somebody's like, yeah, I just levered up, that because of what you said. It's like, no, guys, that's not what I'm saying.
Not financial advice, everybody, please.
But I think, yeah, go ahead.
Question 4, Dan. Then this one kind of bleeds right into to what we're talking about here, like the math finally working. Talk to me about what Canadian city has the best cash flow right now.
Man, if only there was a website that all of the assets on the market by yield and cash flow. But yeah, we get amazing. This question all the time. Everybody wants to save themselves the headaches. Yeah. Yeah, we built that. We're going to do a whole episode on Realist, by the way, like our vision for it and like what we want it to accomplish. I realize we've been talking about it in kind of like a tease.
Yeah.
I really want to like build the best. And like it's possible now with AI and vibe coding, especially Fable and whatever. But we want to build the best investor platform for realtors, for investors in Canada. And I think because we have the audience, it's like makes it easy to get traffic there so that we can people using it and collecting those data points and also telling us how we can refine it. So we'll do a whole episode talking about Realist over the summer when the most faithful of listeners are still around. I think that we get this question, and our goal with the site is part of it is to answer this question. A lot of people wanted the process of having a show and find what markets seem to be performing the best, so that they can then go and only look at finding the assets within that market. It really just, I hate to give like a half-assed answer, but it does depend on what you mean by, people throw around so many metrics and half the time they don't even really know what they're talking about. So like, are we talking cash flow? Are we talking like cash on cash return? Are we talking, so there, and I think there, a lot of regulatory things happening now, like Alberta, Calgary, as an example. Like, why did we do our multiplex event in Edmonton? Well, Calgary wiped out 80% of their multiplex up, so there's a lot of, Airbnb investors learned how quickly the stroke of a pen can blow up, and student rental investors just learned the same thing. So I think there's a lot of regulatory risk there. I think focusing on cash flow is important, but it's maybe not the only thing.
I also think that it can mean so many different things to different people. And, for instance, like if you just mean pure positive monthly cash from day one on a turnkey prop, you're likely paying a lot more for that than you would something that you're going to have to go and fix and buy and hold,
do some work, right? And then you get some forced appreciation, get a return on that. That's not really necessarily counted in cash flow. Yeah.
But but like turnkey props, Edmonton, Winnipeg, like parts of Saskatchewan, Sudbury, Thunder Bay, like kind of those like
Moncton,
Moncton, shout out Moncton, like all those markets I just mentioned, right? I'll do that again: Moncton, Edmonton, Winnipeg, some parts of Saskatchewan, Sudbury, Thunder Bay. Those are your lower entry price points, decent rents, and the math in a lot of cases, again, I know people are going to, well, I invest in there and I'm getting screwed. Not every deal, okay? But I'm saying you can find good deals there, and the math in a lot of cases kind of works right out of the gate.
Yeah. Yeah, and then I think if you go over to total return, like cash flow plus appreciation potential plus development or like upzoning or multiplex potential opportunity, Alberta in its entirety would be hard to beat if you buy the right assets. Like, it's the only population growth province right now. There's no provincial sales tax. You're getting upzoning in a lot of places. Price to incomes are reasonable. So your marginal buyer demand, that's keeping the market moving. So I would say like, I like Alberta in that. I think it's tough to beat, like just from market fundamentals actually still existing. There are other markets I like for more personally for different reasons. But if we're just talking about those actual variables, that one stands.
Yeah, no, for sure. And look, if you're talking about it, kind of that emerging market plus the upside. So the kind of some of the places I was mentioning, but going back to I'm putting money into this, putting sweat equity, your Halifaxes, your Monktons, Charlottetown, Atlantic Canada is popping off, double digit appreciation last year. Rents are still climbing. Vacancy is below 3% across that entire region of the country. I would be looking there. I mean, we're literally giving everyone right now great markets to look at. I'm not going to tell you the best market because there's no such thing as the best market. It depends on who you are, your asset class, how much money you have, what kind of property, what kind of work you're looking at. But these are all great places to look at.
And then I think if you are thinking cash flow specifically from, adding a new unit or ADU or going to multiplex, you go to like Ontario, we got Bill 23B, Bill 44, you get zoning that makes it easy for you to do this. So if you have the cash to spend on construction, cash flow, like if we're just talking cash flow again, profit on top of your mortgage payment, like, well, you can make that way better by just going on a 50-year AM on CMHC MLI Select, right? So it's one of those like very subjective, like the question is there's too much range for how you can manipulate cat. That's so let's jump over to 5.
Yeah.
Should I be incorporating? This is one of my favorite because of the holdco myth that I think we've talked a lot about on the show, but I think it's like everybody always, I'm going to pay less tax or whatever. That's actually technically not true, by the way.
Yeah. Okay. So, and again, not financial advice. Question 5 of the most Googled questions of 2026 so far. Should I incorporate my rental? One of the top investor questions, Dan. We've gotten it so many times. We've done episodes. Short answer, probably not. At least until you cross a clear threshold in your investing journey.
Yeah, and I'd say like usually your accountant would decide this for you, and the threshold that most accountants that we talk to on the show or that like our clients or listeners that we speak with use seems to be that 3 to 5 rental property area. When
the base, like probably minimum 3 at least.
Yeah. And below that, like the cost of incorporating and the cost of filing corporate income taxes and all of these other things typically eat the benefits, I would say.
I mean, look, you got legal costs, annual maintenance that's going to cost you a couple grand, separate corporate tax returns. Dan, we've got a couple corps together. You're doing more taxes for more different stuff. The banks are tighter on those kind of mortgages. Usually have a bit of a higher rate, a couple more hoops to jump through, and you have to personally guarantee it. And if you're buying in a corporation, right, you have to personally guarantee. So you're not even fully isolating your liability in some cases, but there is definitely a place where most investors get where it definitely makes sense, especially if you have a bunch of partners and you're buying larger buildings. But in most cases, for a lot of you starting out there, own 1 or 2 or maybe 3 properties, I'd say it's even like, after 4, you can get away pretty with 3. It in my unprofessional opinion over here. Talk to your accountant.
Yeah. Yeah. And I think in many cases, like most people are approaching their accountants assuming they're going to get a tax benefit from corporate, but passive income inside a corporation is taxed at the passive income rate, which is high, I think. And in Ontario, rental income earned passively inside a holdco gets taxed at 50.2%. Well, if your personal marginal rate for a lot of people, I'd say for most investors is lower. And, in a lot of cases, like most people will leverage up to the point where they're comfortable with the leverage point and cash flow scenario. And you're paying so much interest usually at that point that plus the depreciation on the asset that you're not claiming a ton of income on your rentals that is like that income tax component matters a ton. So it's like, well, capital gains, I think the capital gains rate is the same too, right? So
I mean, look, I think basically it comes down to once the liability exposure justifies the structural protection, the work, and the money, then it's time to do that. So again, tough question to answer. These are all such tough questions to put like a big blanket statement on. And this next, I guess
that's why people are Googling them, right? Like they're trying to do research because they are very like open-ended and like difficult questions to,
Yeah. I mean, this next one's not any simpler, right? Can I still Airbnb my secondary property? Dan, this is a complicated one. And hit me with the first piece here.
Yeah, I mean, I think you had that COVID period, kind of COVID when everybody just became Airbnb investors because like everyone was like staycationing, in like cottage country or whatever, and moving there. So that I think that wave of like all those Airbnb bans, which are many of which are being walked back now, by the way. because one, they didn't accomplish anything, and two, we like don't have a problem with Airbnb. Well, I think it revealed that Airbnb wasn't actually the problem. Bringing in 1.4 million people without building 1.4 million homes was the problem. But let's like go province by province and kind of quickly fire off whether you can do this.
Yeah, I mean, in BC, short answer is mostly no. The Short-Term Rental Accommodations Act came in May of 2024. A year later, May 2025, every host must register provincially. You can only have your short-term rent so you can only rent your short-term principal residence plus a secondary suite or an ADU in the same property. Your condo, your cottage, your investment property. In most cases, I know there's some exemptions in smaller areas of the province, but you can't legally rent it short term, and the fines are pretty big. So be careful out there. Dan, hit me with Ontario.
So in Ontario, it's not like BC where they have a provincial province regulation. In Ontario, they've left it up to the municipality, so it varies city by city. Toronto requires registration. In most cases, principal residents only. There's 180 nights per year cap. Fines are big. Muskoka has license caps. A lot of those like kind of cottage country markets where you're getting, what do they call them? Party palaces or something like that. There's a bunch of articles about them, like NIMBYs. Ottawa, Hamilton, Niagara. Each of these like major markets has their own framework.
In Quebec, provincial registration is required. Plus, there's going to be municipal layers. Montreal does restrict to principal residents in most of the boroughs there, but there again seems to be some exceptions. Mont-Tremblant, pretty tight zoning, smaller eastern townships, municipalities, kind of still the Wild West, but a lot of them seem to be clamping down as well.
Yeah, you jump over to Alberta. I mean, like most things in Alberta, it'd be the most permissive of provinces, the Wild West. No provincial registry. I think the major cities, Calgary and Edmonton, do some like municipal rules, but they're very light. So if your thesis depends on Alberta, that's probably your safest bet on regulatory exposure.
Yeah. And then let's jump over to the East Coast, Atlantic Canada. This one's tough because it varies widely over there, right? Halifax, very little rules. Some rural New Brunswick is still wide open. PEI, really cottage-friendly frameworks not existing. This is the only Canadian region where STRs are still being actively purchased by investors. So look, the universal rule, talk to a lawyer, talk to your accountant, figure out what you are allowed to do, because there are some pretty hefty fines. Dan, let's get to our final big question here, and then we'll really rip through the two rapid fire ones. How do I maximize the principal residence exemption? This is one of the top tax questions every year. Again, we are not accountants. Go and speak to your accountant. We're just two guys talking about this, all right?
Designated property per year as principal residence. That property's capital gain is fully exempt from tax when sold. So the property has to be actually lived in by, I think the technical language is ordinarily inhabited in that year. Even, a seasonal use like a cottage or whatever would count, as long as it's like, regular. Like if you owned a house in a cottage, I don't think they really care, because you can only apply it to one of those two assets anyway.
Most people default to their primary home every year for ownership, and that's wrong if you own a secondary property, cottage or investment property that you lived in for a while. Kind of the appreciation can be faster on a year-over-year basis. So again, this is stuff that you got to talk to someone on your power team about.
Yeah, and when you sell, you would compare the per year capital gain on each property, and then you get to do a designation, right? And that's which one would have it is what this, like the CRA would let you move it around, to my understanding, to minimize total tax. Again, these are like informational purposes only. Ask your accountant, but don't Google it. Probably, yeah.
Google it and take it to your accountant. This is like WebMD, dude.
Yeah. You might get like a ChatGPT answer from this, but I feel like probably best safely answer by your accountant on that one, because I think the downside risk of messing up a huge capital gain with the CRA could be a pretty hefty penalty.
Yeah. Okay. Well, let's leave that one at that. Couple bonus rapid fires before we get out of here, Dan.
So
hit me.
All right. I'll just ask you and then you answer, and then I'll try and answer. So is it cheaper to buy or rent right now?
depends on when and who you break even on buying versus renting. That's where home ownership starts beating renting in the lifetime total cost, right? 3 to 5 years of owning and holding versus what you're renting for, transaction costs, land transfer, tax, lawyer fees, commissions for the people involved. The eventual say it's such a tough question to answer because who are you?
It's a time in the market thing
Where
because of switching
exactly?
costs, right?
Who are you? Where are you in your journey? How much money are you making? Where are you living? Where are you planning on buying? How much is your rent right now? How much more could you afford? Are the bank of mom and dad involved? I can answer your question with 6 more questions because that's what it takes in order to really provide a real answer. In high level, look, sure for some people, and hell no for others.
So I will take a different approach and say, objectively, if you're good at saving money and you're good at investing, renting beats home ownership on the short term and the long term all day long. The problem is that most people are not good at saving money and most people are not good at investing. Data would prove this in Canada and in the US. And so this is why people like using their primary residence as a wealth building tool, because it's forced savings and it forces you to put those savings into a hard asset that does okay, right? Like it is an excellent asset class. I love real estate. Obviously, we have this show. Actual math would tell you that if you rent and save the difference and invest in just the S&P 500 index or BMO ETF version of the S&P 500 index, you'll typically beat homeownership. But most people won't do those things. They won't save the money and they won't invest in
right
BMO ETF. And that's the problem, right? So
yeah.
Hit me with bonus number 2.
What's the deal? And again, these are the most Googled questions, is the final one of the night. What is the deal with the new 30-year amortization for first-time home buyers?
So basically, first-time buyers can get 30-year AMs on insured mortgages, so anything under 20% down. Also applies to any buying a brand new home, regardless of if they're a first-time buyer. So that was like one of the first layers of like stimulus that we would see on the government trying to pull some capital towards that new build market to keep the construction machine moving.
Yeah.
And that was at the same period of time. The same policy, we did a bunch of episodes on it, but when you saw the CMHC cap move from 1 million to 1.5.
Yeah. And short piece here, you pay more in interest. That there's a trade-off. 30-year AM helps you get more house today, but it's going to cost you more over the lifetime of that loan. So again, know that and understand that. And instead of Googling this stuff, write Dan and I, and we will research it for you and talk to industry professionals and write great podcast episodes for you to listen to. So you don't have to go to Google and Claude and ChatGPT. On that note, thank you so much for listening. Check out realist.ca if you're looking for deals. Honestly, Dan, probably most of those questions could have been answered if they just went and listened to our podcast and looked on realist.ca.
We do report, most episodes now have like a companion report on realist.ca where you can click around in all of the charts and whatever. I just did one for all the Google charts, so you can actually see all the Google search trends. It's just like, and it sounds like I'm doing a bunch of work, but I literally, vibe code to do it. It fires up a sick report. So go enjoy that stuff, and you can see all that we're talking about on the show. And we're going to do a whole episode on realism over the next little bit, because I really want to get the audience involved and engaged in this, as people seem to be interested in real estate investing again. Anyway, talk to you soon.